Welcome to the deep dive. We sift through the sources, you get the insights. Okay, let's just jump right in. How many times have you heard it? That whisper, about the next big stock.
Or someone claiming they know the market's about to make a big move.
Exactly. It's that siren song, isn't it? Outsmarting Wall Street, getting rich quick. It sounds so exciting, like this high-stakes game you can win if you're just clever enough.
It really taps into that desire for a shortcut.
But what if one of the most respected investing books out there basically says, forget the chase? That there's a simpler, maybe more profound way. Today, we're diving into A Random Walk Down Wall Street by Burton Malkiel. Now, this book first came out way back in 1973.
A long time ago.
Yeah, but it's been updated loads of times. It's still incredibly relevant, truly one of the most important books on investing, well, ever written, really. It can totally shift how you think about building wealth.
And the core idea, I think, throws a lot of people off at first. It's very counterintuitive. Malkiel essentially says that stock prices, especially in the short run, they just move randomly.
Randomly? Like no pattern.
Pretty much unpredictable day to day. So trying to guess the next move,
Yeah.
it's incredibly hard to do consistently.
Okay.
So that path to long-term wealth he talks about, it's not about complex strategies or trying to outwit everyone else. It's much simpler. It's about low-cost, long-term, diversified investing.
And specifically index funds, right? That's his big thing.
That's a huge part of it, yeah. The elegant simplicity of just tracking the market.
Okay, so randomness, that sounds a bit, I don't know, discouraging if you're hoping to actually get ahead. How does he turn that into something you can actually use?
That's the beauty of it.
Right. So our mission here is to unpack all that for you. Malkiel blends financial history, some pretty solid economic theory, and really practical advice. We want to give you that shortcut to understanding why sometimes simple really is better in investing. Hopefully you'll have a few aha moments.
Definitely.
Okay, so let's get into that big idea first, the unpredictable market. Malkiel kicks things off with this random walk theory. What exactly does he mean by random walk?
Well, think of it like someone stumbling around randomly. Where they step next has nothing to do with where they just stepped.
Okay.
He argues stock price movements are like that in the short term. Today's price change doesn't really predict tomorrow's. And the reason, it's key. Prices already reflect all the known information out there.
All of it. Instantly.
Pretty much. So trying to find some edge, some piece of news others missed, by the time you act on it, the market's probably already adjusted the price. You're always playing catch-up.
So you're fighting a losing battle, trying to outguess it constantly.
That's the core argument, yeah.
Yeah.
Especially consistently, day in and day out.
And that ties directly into the efficient market hypothesis, the EMH, right? That's like the academic backbone.
Exactly. EMH takes that random walk idea and formalizes it. It basically states that security prices, stocks, bonds, whatever, fully reflect all available information at any given moment.
So any news, good or bad, gets priced in almost immediately.
Super quickly. As soon as information hits the street, algorithms, traders, everyone jumps on it, and the price adjusts. That efficiency makes it incredibly hard to consistently beat the market, especially after you factor in trading costs and taxes.
Which often get ignored.
They really do. It's not about being smarter. It's about recognizing how fast information moves.
Wow. Okay, so for the average person listening, this is like a fundamental shift. Forget trying to pick the next Apple or time the market dips perfectly.
Malkiel essentially says, don't waste your energy. The market's probably already figured it out.
It's humbling, isn't it? It goes against that gut feeling that you can spot something others miss.
It really does. But he argues that trying to pick winners or time the market, for most people, most of the time, it just doesn't work out long term. The focus should shift from beating the market to just participating in its overall growth.
Okay, but hang on. If markets are so efficient, how do we explain things like the dot-com crash or the housing bubble? Those felt anything but efficient or rational.
Great question. That leads us to the next really fascinating part, the human element. Malkiel argues that while markets might be informationally efficient most of the time, they aren't always psychologically rational.
Meaning people mess things up.
Basically, yes. He walks us through history, showing how human psychology repeatedly fuels these massive speculative bubbles and then the inevitable crashes. It's quite a tour. He talks about tulip mania back in the 1630s.
Where tulip bulbs cost fortunes, right? Crazy.
Insane amounts, more than houses. Then you have the South Sea Bubble in the 1700s, another classic case of mass speculation gone wild.
And the Roaring Twenties leading to the 1929 crash.
Yep. And more recently, he covers the dot-com bubble, which many of us remember,
Oh, yeah.
and the 2008 housing crisis. The key takeaway isn't just that these happen, but that they show recurring patterns.
Patterns driven by.
Human nature. Greed when prices are soaring, fear when they're crashing, and maybe most powerfully, that herd mentality, everyone rushing in or out together.
It sounds like we just keep making the same mistakes. How does Malkiel suggest we recognize these things or avoid getting caught up?
This is where he brilliantly connects finance with psychology. He really digs into behavioral finance. The core idea here is that investors aren't the perfectly rational calculators that old economic models assumed.
We're human, basically.
Exactly. We're driven by emotions and biases. Things like overconfidence. I know better. I can pick the winners.
I think we all feel that sometimes.
Absolutely. Then there's herd behavior, just following the crowd because it feels safer even if the crowd is heading off a cliff.
Like buying into a bubble because everyone else is.
Precisely. And loss aversion, that feeling where losing $100 hurts way more than gaining $100 feels good. It makes us sell low in a panic.
Okay.
And anchoring, where we get fixated on a past price, like, oh, this stock used to be $50, it must be cheap at $30, even if the company's fundamentals have totally changed.
And Malkiel argues these biases are what actually fuel the bubbles.
Yes, they create this feedback loop. Rising prices feed greed and FOMO, fear of missing out, pulling in more buyers based on emotion, not fundamentals. Then when things turn, fear and loss aversion trigger panic selling. It becomes self-fulfilling.
Wow, so our own minds are kind of working against us in the market.
Often, yes. It makes rational investing really challenging during those periods of euphoria or panic.
Okay, so if the market's efficient but people are irrational and trying to pick stocks is tough,
Yeah.
where does that leave the average investor? Does Malkiel just say, good luck?
Huh. No, not at all. This is where he pivots to his constructive advice, starting with a critique of common strategies people use to try and beat the market.
Like technical analysis? Reading charts?
Exactly. He's quite critical of technical analysis looking for patterns in past price movements. He argues, based on the random walk idea, that those patterns are mostly illusory. Past squiggles don't predict future squiggles if the movements are random.
Okay, fair enough. But what about fundamental analysis? Looking at a company's earnings, its debt, its management quality, surely that has value.
He agrees fundamental analysis is useful for understanding a company's intrinsic value. But, and it's a big but, he argues it's still very limited in predicting future stock performance.
Why? Too many unknowns.
Too many unknowns. Future events, competition, economic shifts. It's incredibly complex. And crucially, even if you do great fundamental analysis, that information might already be reflected in the price because other smart analysts are doing the same thing.
Back to market efficiency.
Right. And then he looks at the pros of professional money managers running mutual funds.
Do they beat the market?
Well, the data, consistently over decades, shows that the vast majority of actively managed funds fail to outperform a simple market index, especially after you account for their higher fees and trading costs.
That's pretty damning for active management.
It is. If the professionals struggle, Malkiel asks, what chance does the average individual have trying to do the same? It really strengthens his case for a different approach.
Which brings us back to index funds.
Exactly. This was truly revolutionary when he first started advocating for it so strongly. His solution is beautifully simple. Buy and hold low-cost passive index funds.
Like one that just tracks the S&P 500, for example.
Precisely. Or a total stock market index or an international index. The advantages are huge. First, you get instant diversification. You want a tiny piece of hundreds, even thousands of companies.
Spreads the risk.
Massively. Second, the fees are incredibly low compared to actively managed funds because there's no highly paid manager trying to pick stocks.
Less cost drag on your returns.
Right. And third, you reliably capture the market's overall long-term return. You're guaranteed to match the market minus those tiny fees.
It's amazing to think he was pushing this idea so early, before Vanguard really took off, before it became mainstream.
He was a real pioneer. It seemed almost radical than suggesting you shouldn't even try to beat the market, just match it cheaply.
It does sound almost too simple. Is that why some people resist it? Like it doesn't feel sophisticated enough?
I think that's part of it. People want to feel clever or they believe they can find an edge. But Malkiel grounds this simple strategy in some serious academic work. It's not just a lazy approach.
Right. You mentioned modern portfolio theory, MPT.
Yeah, MPT provides the mathematical proof for diversification. It shows how combining different assets that don't move perfectly together can actually reduce your overall risk for a given level of expected return.
So the whole is less risky than the sum of its parts, kind of?
In a sense, yes, and index funds are a practical way to achieve that broad diversification easily. He also connects it to things like the capital asset pricing model, or CAPM, which helps explain the relationship between risk and expected return.
So the simple index fund idea actually rests on some pretty complex financial theory.
It does. It's this elegant bridge between theory and practice. Diversify broadly, keep costs low, stay the course.
Okay, so the theory is compelling, but Malkiel also gets very practical, right? He has this whole section on personal finance and life cycle investing.
Absolutely. He stresses that investing isn't one size fits all.
Ah.
Your strategy needs to adapt based on your age, your goals, and how much risk you're comfortable taking.
So what does that look like?
Well, for younger investors, say in their 20s or 30s, they have decades before retirement. They can afford to take more risk for potentially higher growth. So he generally advises a portfolio heavily weighted towards equities, towards stocks.
Because they have time to recover from market downturns.
Exactly. As you get into middle age, maybe your 40s or 50s, retirement's getting closer. You still need growth, but you also want to start protecting what you've built. So he suggests balancing stocks with a larger allocation to bonds, which are generally less volatile.
A more moderate approach.
Right. And then for older investors, or those already in retirement, the priority shifts much more towards preserving capital and generating income. So the allocation tilts further towards bonds and other safer assets.
That makes intuitive sense, matching your risk to your stage of life.
It's crucial,
Yeah.
and it avoids making drastic changes based on market noise rather than your own circumstances.
And he also talks about dollar cost averaging, which seems like a really straightforward technique.
Oh, it's fantastic. So simple, so effective. Just invest a fixed amount of money at regular intervals, say $200 every month, into your index fund no matter what the market is doing.
So you buy more shares when prices are low and fewer when they're high automatically.
Precisely. It takes the guesswork and emotion out of it. You avoid the trap of trying to time the market, and it enforces discipline. Just keep investing steadily through thick and thin.
That seems like one of the most powerful tools for dealing with those behavioral biases we talked about.
It really is. So if you boil down Malkiel's actionable advice, it's pretty clear.
Okay, let's recap those steps.
1. Buy low-cost, diversified index funds. 2. Spread your investments across different asset classes, stocks, bonds, maybe some real estate. 3. Use tax-advantaged accounts like 401ks or IRAs whenever possible.
Maximize those tax benefits.
Definitely. And 4. Rebalance your portfolio maybe once a year or so, just to bring your allocations back in line with your target mix based on your life stage.
So, nothing overly complicated. It's more about setting up a sensible plan and sticking to it.
Discipline is key.
And that's really the core message for listeners, isn't it? These are things you can actually do. It puts control back in your hands, not by trying to outsmart the market, but by being sensible and patient.
It's empowering because it suggests that successful investing is within reach for almost everyone, without needing secret knowledge or taking huge risks.
Okay, so wrapping this up, this deep dive into a random walk down Wall Street, it leaves us with some really powerful takeaways. First, short-term market moves. Unpredictable. Don't try to time them.
Right. Second, markets are generally efficient. Prices reflect information quickly. Getting an edge is tough.
Third, those bubbles and crashes, they happen again and again because, well, human psychology gets in the way. We're predictably irrational sometimes.
Fourth, the elegant solution. Low-cost, diversified index funds usually win out over active strategies in the long run, especially after costs.
Fifth, discipline is everything. Patience, staying the course, ignoring the noise, resisting panic or euphoria.
Crucial. And finally, tailor your approach. Use that life cycle investing idea to match your portfolio to your age and goals.
The impact of this book is hard to overstate, isn't it?
It really is profound. Malkiel was instrumental in popularizing index funds. John Bogle, the founder of Vanguard, championed these ideas and built a company around them.
And even Warren Buffett gives it his nod.
Yeah, Buffett has famously said that for most people, the best thing to do is just buy a low-cost S&P 500 index fund. Trillions of dollars today are invested this way, and a lot of that traces back to the logic Malkiel laid out decades ago.
It genuinely changed the landscape for ordinary investors.
Completely.
So here's a final thought to leave you with. If building wealth turns out to be less about frantic activity and outsmarting everyone and more about simplicity, patience, and discipline, where else in life might that random walk mindset apply?
That's interesting.
Yeah, maybe accepting you can't control everything, focusing on consistent effort rather than trying for impossible breakthroughs, trusting the long game, Could that reduce stress and lead to better outcomes, not just in finance, but in other areas too?
Letting go of the need to perfectly predict or control everything.
Exactly. Something to think about as you navigate, well, your own random walk through life.